Hello guys and welcome back to my YouTube channel. This video is very important for me to establish a baseline of just getting on the same page with you, right? Because I'm gonna have a lot of technical videos coming up. So I want to ensure that you understand the terminology I use. It's mostly ICT stuff, you know, but each and every person and teacher has their own twist. So I just want to establish that baseline of understanding what I'm even talking about when I'm going and look and explain charts. So very important one for me to establish that. So first goal of this video is to establish that baseline, what I just said 3 times. Second one is maybe you're a beginner trader, maybe you are not familiar with the terms or how to describe price action, so this is for you too. But also the ICT people that are already knowing what an order block is, what FVGs are. I'm really trying to connect the dots here, not just explaining the specific ingredients to describe price, but also connect the dots. And I think even if you know ICT terms in general, I'm pretty confident that there is something in this video that you can take away from it. So let's jump right to the charts. Thank you for being here. So first off, we're gonna start with market conditions, general market conditions. What can the market do? It can either range or trend. So ranging conditions or consolidation is this, where it's just prices zigzagging, stuck between one high and one low and not going anywhere. This is generally unfavorable trading conditions. We wanna not be involved in the market when it is in such a period. What we rather want to see is the market being in a trending condition. Like so. Here we can see a clear bearish trend. Bearish means going down, bullish means going up. So here we can see we have a high, we have a low, we have a lower high, lower low, lower high, lower low. Clear bearish trend. When we are defining or drawing a trend, we are automatically also drawing price legs, which is simply the distance from a lower high to a lower low in that bearish trend and vice versa. So we have here another lower high and another lower low. So this is a new price leg being drawn up by us. This is already the first point where a lot of traders go wrong. Keep it simple when you're drawing these trends. Okay, this is a clear bearish trend still because we have not broken this clear, obvious structure here. So don't start thinking that we are now in a bullish trend because we have this happening here, okay? View the chart from a macro perspective and draw out only the obvious stuff, like just a couple of price legs per chart, so that you don't get confused what your actual trend is, okay? Even your dog has to understand what the trend is because it's so obvious what you're drawing, okay? And so simplified. So within these price legs, we are dissecting into 2 halves, and the upper half is premium and the lower half is called discount. So institutions, the guys that really move the market, because we retail traders, especially now with prop firms, everybody just doing demo stuff, we are not really influencing where the market goes. It's all the institutions that move the market. So when we are in a bearish trend, price generally wants to or has to go into a premium level to sell off again. Because it's just the institutions, if they place a load of orders, they're obviously going to place it for an attractive price. So obviously selling expensive is attractive. So it's going to be in the upper part of a price leg where they sell. And the market is looking for liquidity, looking for orders. If there is a lack of orders because the institutions are here, guess what? Price is going to come up here first before we sell off again and break this low. So it's a very important concept, but I want you to view premium discount not as this how do you say, a binary? No. Yeah, binary thing, but rather like this, okay? It's like this is shallow premium. It's not like on the 50% line, it's like switching from discount to premium. No, it's gradual, obviously. So this is shallow premium, this is solid premium here, and this is extreme premium. So see it rather from this perspective and not as a binary thing. So one general rule in the trading world, and at least in my system, and I think it just makes sense in general, is don't look for buys in premium and don't look for sells in discount. You want to sell in premium and buy in discount. So obviously here we are in a bearish trend. So if we want to take this pair lower, we have to look for sells in this area in premium. And obviously we can draw the premium discount also for our second price leg. So this is looking like this. So we can see this is already in proper premium and it's possibly gonna continue for a lower low here. The next term we're going to use a lot is called retracement or pullback. This is this green arrow, for example. This is always the part, as you can see right here. The price legs are the bearish pushes within a bearish trend, the bearish legs. And the pullbacks that we have in every trend, the upper parts that are not dominant here, this is called retracements or pullbacks. And the green arrow reflects the structure of the pullback, which we will also refer to internal structure, because we are forming structure within this bearish structure with the external structure that is actually defining the trend. So the bearish legs here in this bearish trend is the external structure, and here as a retracement, as a pullback, we are forming internal structure. So here at this point we are internally bullish, but we are still in a bearish trend. And there is the specific term complex pullback, which is perfectly describing this pullback, which is just, you can see it's a clear internal, nice and obvious bullish trend. But this is where a lot of traders go wrong. They think, okay, we are in a bullish market. No, the market is still bearish. Until this high gets violated, we are still bearish. So this is the typical nature of a complex pullback. It basically wants to sell you a bullish trend, but it's not. It's just a complex pullback. It's just forming liquidity, which we will come to later. And it is still just a pullback. We are still in a bearish trend. Then the next term we use a lot. Me personally, not as much anymore, but you're gonna come across the YouTube space a lot hearing this word, so I might include it. And I was working with it in the beginning of last year, which I will cover later on this channel, so yeah, it makes sense to introduce you to it. So the fib retracement is basically just a measurement tool of how high the retracement is going. So in this price leg, the retracement, we saw a 75% retracement, so or a little more, like 80. So that means that the retracement, the pullback, the complex pullback, was going as high as 80% of the total range of the external leg of our price leg that we are still playing in. It also reflects the proportion of the take profit versus the stop loss if you would want to trade it. So if you put a position tool here, if it lets me, and you put the stop loss at the high of the price leg and the take profit on at the low, doesn't let me show it, wait. Let's make this a little smaller. You can see that 75% of this position tool, as the fib says, is take profit, 25 is stop loss, so therefore we have a risk to reward 75 through 25, which is 3, and the same goes for all the other values. In this case we have 67% take profit area, therefore risk to reward is 2, and 50-50 is obviously risk to reward 1. So that's a neat little detail about how to use the fib level. But it's also a chill way to enter trades if you don't want to over-refine entries. You can simply just say, okay, I'm just gonna always enter here, always 75% for a constant risk to reward of 3. Me personally, I rather use price action to look for entries, which I come later in this video. And but I was starting out like that to keep it simple, and yeah, I don't regret that I started out like that, kept things a little more simple and added complexity later on in my trading career, and that's how it should be. So let's simplify and recap. First of all, fib retracement we don't need anymore, premium discount buy for now, price legs buy for now, this we don't need. So this is our external structure, and this is our internal structure, just as a repetition. And the external structure points are therefore only the highs and lows of the actual overall trend. And the internal structure is the internal structure of the complex pullbacks or pullbacks retracements in general. Now we come to the term Breakoff Structure. So let's clean this up again. So first of all, external Breakoff Structure, or first of all in general, Breakoff Structure is when price leaves the current structure to make a new structure, and that is either to extend the trend or to flip a trend. So first of all, we have external breaks of structures. So we see that this bearish trend creates a new lower low here, therefore breaking the previous lowest low, which was here. So this is an external Breakoff Structure. And here we do the same thing again. We get our retracement and then we break the external structure, which is now here again, to extend the trend. So these are both trend extending Breakoff structures and external Breakoff structures, because we are making lower lows in our bearish trend. Then of course we have the same with internal structure. So we have obviously also our internal structure here, and we can see that we, for example, break above this high here, which is a Breakoff structure, and then we break below this low, which is also a Breakoff structure. So these are internal breaks of structures, and this one is actually trend flipping. So this, as you can see, we are in a bearish trend, and obviously we are still overall in a bearish trend, but from the internal perspective now, we are flipping bullish here because we break this last bearish low, higher low. So this is why we can also call this Breakoff structure a change of character, which would be here. Let me get a little bit cleaned up the chart here. So we can see here one example and down here another. This is where we flip bullish on internal structure. Therefore, this is called a change of character. So we flip from a bearish character to a bullish character internally. That's why this Breakoff structure can also be called change of character. So since this change of character is only internal, how would an external change of character and a true flip of our external trend, of our general trend look like? Would look like this, okay? If price would continue up higher here and violate this external structure points, then we have a change of character of external structure flipping from bearish to a overall bullish trend or market. So in general, you can say that we have a lot of Breakoff structures, which you can see here. If you really want to draw every change of Breakoff structure, this is where nuance comes in, right? Of course, you can take a million or draw a million Breakoff structures, but you only need when they matter. And this is where context comes in. And this is why trading is hard. It's not just, okay, you just use this concept and you draw a little bit. No, you have to find meaningful Breakoff structures. And this is what I want to teach you in future videos. So general, we have a lot of Breakoff structures, right? And only a little bit of them, or just few of them, are actually also a change of character. They have that additional attribute of flipping a trend instead of extending it. And from these change of characters, only a fraction of them are actually trend flips, actually flipping external trend. And this is where a lot of beginner traders go wrong. They see trend changes all the time, and they are like, what am I supposed to interpret as a trend right now? And there's just, yeah, it's actually a good insight that these external Breakoff structures, these really trend flipping things, they happen very rarely. And the most Breakoff structures are just trend extending nature or just internal structure changing nature. So don't get confused here. And I'm going to teach you in future videos how to look at the most meaningful Breakoff structures and be very selective in the ones that you actually draw out and use for your confluences for trade ideas. So let's clean the charts up again real quick. Next thing we're going to talk about is momentum. And momentum is simply the angle in which price moves. So high momentum is a move like this, super steep, and low momentum is something like this. You can clearly see that this bearish leg has more aggression into how price moved versus the complex pullback that is just generally choppy and low momentum. So generally speaking, when you see a trend like this, mostly in a bearish trend, you see that there's a strong move down and a flatter move up, and a strong move down and a flatter move up. Can also be something like this, complex pullback, choppiness, you know, and then strong down again. And these strong downwards moves, they don't show us only institutional activity, but actually institutional consensus to, like, basically all institutions are selling. Obviously not all, but most of them. And this is what can cause such a violent move. And this is very good as a confluence for us, because if we see something like this, aggression, consensus of the institution, and a choppy move up, this is giving us confirmation that this trend might not over yet. So that was it so far with general terms. Now we go a little bit more into the ICT specifics. And we're going to start off with the good old order block. So an order block is basically an area of, or a little tiny range before a violent move begins. So we have a couple of criteria that go into our order blocks, and we have to have them all checked to classify a little bit of a range before an explosive move as an actual order block. So generally it's important for us that we only draw up an area as an order block when we are certain that is a decisional point in price where institutions reached kind of an agreement or a consensus where the price should go next. So what we really need to see is an intentional move that causes an imbalance, going into the next word, imbalance. And an imbalance is a gap between, it's a 3 candlestick formation. So you have the first candle here, then you have a big candle downwards, and the third candle. And an imbalance is basically the gap between the first and the third wick. So you see the huge gap that we have here between these 3 candles. This is what a fair value gap is. So we also call that imbalance. It's exactly the same thing. And this is also our first criteria for an order block to be an actual order block. It has to cause an imbalance, a strong push down. And the next criteria is it has to also cause a Breakoff structure. If it's an external Breakoff structure like here, it's even better. So this is a strong order block here. We have a clean big imbalance. Another criteria for a proper imbalance, it has to stick out. You don't have to search for like, okay, we have maybe a tiny imbalance. Like here, look at this. This is also an imbalance, but it's so tiny. If you don't have your resolution in the video maxed out, you're not gonna even be able to see it on YouTube. No, this is not an imbalance that we want to see as a true imbalance. It has to stick out like here. This is so obvious, right? And this is a proper imbalance. And this is also a proper Breakoff structure because it extends the external range. It's not just look, this is a Breakoff structure here too, it's just internal. But this external break makes the order block even more valid. So how did I actually define the order block? Let's take the imbalance off for now. So the order block is defined by the last tiny range. You see this high and this low, and then a little bit of a mitigation of this high again. And then the move happens. So it's the last tiny range before the FVG, the fair value gap, the imbalance is created. And ultimately this push led to a Breakoff structure. So this little range was the decisional point where the orders were filled of the institutions and we had that push out. So this is a valuable, high probable reversal point for price if price would come back here. So this is what an order block is meant to do. It should give you a high probable area for a reversal to happen. If price comes back here, especially with such choppiness, so slow momentum, this is a high probable reversal area. This is what an order block is all about. Next thing we're going to talk about, now that we have order block and imbalance covered, is supply and demand. So a supply is the bearish version of the demand and vice versa. And I simply draw it as the combination out of order block and the imbalance that got caused by the order block. So as you can see here, the supply area is basically just this general area where you combine the FVG order block together, and this is our supply. Because often, very often actually, price does not come, if there is a trend continuation happening, very often it's just gonna tap into this little imbalance here and then just go. It doesn't often come into the actual order block. So you can see as this whole area as a potential high probable reversal zone. And also what makes a supply more valid is actually being in premium of the external leg, which is the case here. Look, this supply area is at the extreme premium area of this whole bearish price leg. So this is a really good supply area. Sometimes it's a little bit trickier to draw supplies. Let's clean this up. For example, this is also a supply. And here I don't have one clean order block with an imbalance that I can just draw out. But in that case, if it's a little more choppy, just draw it out. It's not rocket science. Just draw up what you would consider the last piece of price action that is like a little bit rangy before the strong push out happens. So in that case, I would say that this is a little range and we come up here one more time, and then we launch the move down. So this is the supply. So don't overcomplicate it. It's not rocket science, just the general area of origin of a strong move. Next term we use is breaker block. So breaker block is something that starts out as an order block and ends up as the counterpart, basically, or with the opposite intent. Okay, so first we are creating this as an order block. You see we have an imbalance here, clearly visible. No overlap of this with the wick of 2 candles earlier. So we have this push out candle that has a clear gap. So also we cause this change of character here, because here we flip internally bullish. So this is a valid order block. This is a valid little demand, basically. So, but what happens next? It gets violated right away. And what the market loves to do is come back up, and this time doesn't test this as a demand, but actually as a supply. So this is a confluence for a supply area to make it even stronger. This break and retest is what we like to call it. So we break this area that was demand, and then we come back to retest it as supply. So this makes this supply area even more valuable, because we have this as a breaker block in it. So next term is a little bit basic, but maybe you haven't heard it yet because you're new to trading, who knows? It's called rejection. It's basically just how a candle looks. And is this candle having a big wick and a small body is rejection. So price explores this price area here, but institutional activity or whatever, a consensus is reached again to sell. So we reject this level right away and close actually rather bearish. It's still a bullish candle, you know, it closed higher than it opened, but it's almost all just a wick. So this is what we call a rejection, or a rejection wick. And mitigation is basically referring to an order block or a point of interest to be mitigated. Why doesn't it let me delete this? Okay, I locked this by accident. Okay, so here we have this imbalance, and this is now mitigated because we just entered this area once. And this is super important. Every area that is significantly mitigated is not valid anymore. So this imbalance, bye-bye, fully mitigated, or not fully, but enough to make it relevant. You know, like more than a third or half is mitigated, so it's not valid anymore. We don't use this as a potential reversal point anymore. The same goes for the breaker block that we had. It's interesting that I don't see it. Because I deleted it. I'm an idiot. But if you see the supply as a whole, it's mitigated but not fully. So I would still say if it comes back up here, there's some chance that it can still reverse, because it's just like 1/4 of the whole supply. But restricting this on the imbalance, I wouldn't use the imbalance anymore, because it has been mitigated 50% and even more. So this imbalance is not relevant anymore. This goes for supply, demand, order blocks, breaker blocks, for everything. Once it's mitigated significantly, don't use it anymore as a potential reversal point. So now that we got this out of the way, we can finally go into liquidity. This is really where the butter goes by the fish, as we say in Germany. So liquidity is a true driver of the market, in my opinion, and it's the most powerful concept that I'm going to show you in this video and that I use in general for trading. So liquidity is basically where the market places traps for traders to go in a certain direction, where most people put their stop losses, and the actual institutions have their stop loss, have their orders beyond that point. So most institutions, they want to order, want to place their orders where you, as a normal trader, so to speak, get stopped out. And this is where liquidity comes into play. And we have different forms of liquidity. The first one being equal highs liquidity. And this is the highs, or the equal highs or lows. Obviously, it's always both sides, or it has always both variants. It doesn't have to be exact. Look how I draw out this liquidity. If price comes back here, I can assure you that a lot of traders gonna have their stop loss here, because it bounced before, right? Can just bounce once more, right? No, most likely not. But you see, this is not exactly the same. You can eyeball it. It has to be relative equal highs. Okay, so in that case, this is a truth. So this is a huge liquidity pool, and most institutions, if price would come here and we have a reason to think that institutions want to sell, this is where they are most likely to sell. So what do we do with that information? That price makes this equal highs here or relative equal highs. What do we do with this? Okay, this in general, we should see this as a magnet for price. Okay, price is likely to, at some point, maybe when this flips bullish in general, externally, that this is a magnet for price. That this bullish trend, if we would flip bullish here, for example, should go for these highs to find more sellers to flip the trend around. Or it could also be liquidity, or violating such a liquidity point is always adding fuel to the fire. Okay, so this can add fuel to the fire in terms of launching a move down with aggression, or it can also feed the continuation of the buys here. So don't see it as a one-way street. This is always can feed the continuation of a trend, or it can flip a trend. Apart from equal highs and equal lows, we have, of course, also some other liquidity types. For example, the bearish trend line or a bullish trend line. Trend lines in general are the same as equal highs and lows. They're just a form of liquidity, a form of trapping people into selling here again because it can have another bounce, right? Or this one I marked as already being taken, the liquidity, because look at this perfect 3-touch trend line, even 4 if you want to count this one, but now it has been swept. Now it has been, these people have most likely been stopped out, or maybe not, you know. Is with the liquidity sweeps, the violations of these levels, you have to have obvious violations, and this is just a small violation. So I don't know if this is like, can be, you can consider as this level being, or this liquidity pool being swept, but it's not as obvious. I would like to prefer seeing this clearly, more clearly violated. Something like this, you know, to really count it as truly taken out, this liquidity. And this one is obviously still intact, as is this one. So yeah. Next form of liquidity that we have is, when we come back to our price legs that we drew up earlier, is external liquidity in general. This just means every lower high and lower low of our bearish price legs, and of course higher highs, higher lows in a bearish in a bullish trend. But in our bearish trend, it's basically every external structure point holds liquidity. Okay, so let's clean this up a little bit. So all these external structure point levels are liquidity. So just for repetition, why are these liquidity pools so important? They are adding fuel to the fire. If this structure point gets violated, it might be just swept, you know, just one rejection wick here, and then we fully reverse. Or it feeds the move up. So all these liquidity pools, see them as magnets for price to go to. And we never know what happens when they are taken. But that's why we also have to wait for the market to show us what is up next. Can either just push through and it fuels the move up and it just runs away, or it can actually cause a shift in momentum from choppy up, we sweep this and we push down aggressively. So even though we have technically swept or broken this external structure, therefore suppose we are bullish now of the trend, but if we see that we chop up here and make a little sweep, you know, just sweep this and then have a momentum shift, then we can say, okay, this is probably just a liquidity sweep that fuels actually a reversal to actually continue still the bearish trend. And this is where nuance and discretion and experience comes in. But when a sweep happens, first of all, we can use the likelihood of a sweep happening use for our targets, right? We can target liquidity pools, but we can also use them for trading away from taken and obviously swept liquidity pools. When we see something like this and the market shows us that it wanted to only stop these people out before making the next bearish push, we can also use this then for entries. So I got one more type of liquidity left, but before I unravel this last piece of the puzzle, I want to connect all the previous pieces and tell a little bit of a story, what was happening in this price action that we see, and in that process reveal that last term that I use all the time and that is so powerful for my trading strategy. So let's begin our story with this order block. This is an order block that has created some smaller imbalances, so it counts as an order block because it has also caused this external break of structure. Okay, so this is a valid order block. So then what happens next? We come back to test this as a supply area, and what does it do? It gives another break of structure. So this was a perfect order block, not just by definition, but also what it did. Price came back to it to mitigate it, reverse from it as expected, and make another break of structure. So this order block is now, it's done its job, it's not longer valid, it's not longer interesting as a potential reversal point. So now what do we do? Price comes back here, gives another little rejection. Do we sell here? No, because this is tapped into. This order block is no longer a valid reversal point, so we are not doing anything. We're just observing price. Okay, we are coming up again. And now guess what? The order block is now become, because it was mitigated, a form of liquidity. And which liquidity is that? First of all, what should we draw this out as? We can draw it out as a break of structure because it is. We are breaking above, first of all, above this structure, but also about this structure. So it's definitely a break of structure, but I'm not going to draw it out like this. Am I going to draw it out as a change of character? I could, because it is, but I'm not going to draw it out as a change of character either, because it's a form of liquidity. It's called inducement liquidity. Okay. Why inducement? Why do we call it like this? Because we are inducing early sellers that want to already speculate on price making a lower external low from here. Because as we know, we are just barely, like this whole order block is basically completely in the neutral zone. It's not in premium, it's not in discount, it's in the middle. So this is a typical area where we would expect from our external price leg to sweep an inducement. This middle ground zone is just not valid enough to sell from. So this is an inducement zone where we basically induce or stop out the people that think, okay, let's just sell from here. I'm impatient, or I'm confident for some reason that it's gonna sell from here. Boom, I get stopped out as an inducement happening. And this liquidity being swept can ultimately lead to more fuel to the fire to continue the trend. Okay, so what did we actually do here also? We mitigated for the first time this imbalance here, nice little imbalance. Of course we also tapped into premium now. It's still shallow premium, but it is premium now. What else did we do? We have this nice order block above the imbalance, so this makes this whole area a clean, untouched supply area. That is generally in proper premium of the leg. So this is making this a valid trade idea to sell, because we also have the rejection here, right? So this can be the confirmation for us to make a sell. Well, I admit this is not the perfect example, because risk to reward technique from a risk to reward standpoint, this is not good. If you want to really cover the external high until here, this is 1.1 risk to reward. It's not really the best of the best, but it's a valid trade idea. Or if you want to be a little more aggressive, you can have your stop loss here for a nice 2.5 risk to reward. This is interesting. Or if you want to cover your ass a little bit more, you can cover this order block here, because this is also an order block. Look, led to a break of structure here, led to a break of structure here, and has the imbalance created here, right? So we can also, if we think maybe it does another inducement, you know, to come even deeper into premium. Sorry, this is the wrong leg. To come even deeper into this premium, we can cover our ass by covering this order block. Okay, this is 1.5 R, still not perfect, but this is a valid trading idea because of all the confluences. This is like now all the puzzle pieces come together, right? We have the strong bearish trend with strong momentum in favor of the bearish trend, a choppy move up. We sweep this middle order block that is not in premium yet. We come into premium and we mitigate this clean supply here. If we want to cover our ass, we can even cover this next supply area here. This is also an order block that has not been fully mitigated yet. So this is a nice confluence trading idea, and this is how we connect these pieces of the puzzle together to get valid trade ideas. So what does end up happening? Ultimately, we get this external Breakoff structure making a lower low within our bearish trend. So perfect. This is perfect price action. Beautiful. Obviously, it does not always work like this, and this is where trading mindset psychology gets in. This is a confluence trade. Obviously, it's still gonna lose sometimes, but this is just perfect for illustration purposes because it actually moved beautifully. You see how the intention in the market is here. The consensus between the institutions. You see how aggressive we push down here. This is perfect price action. It's not always happening as beautifully as this, but the only thing that we have to care about is that it works more often than not. Okay, so next up, let me clean up this mess all full of drawings here. I'm just gonna show you some more inducements in a second. Just give me a second here. Let's remove this completely. Okay, so just some more examples for inducements, okay? This is an inducement that led to a Breakoff structure. You see that? We come up and then we come down within this price leg here. We come down and we pretend here to be still bullish because we have this little change of character here. This sweep can always be drawn as a Breakoff structure or change of character, but ends up from our perspective here as an inducement, because what does it do? Sweeps, rejects Breakoff structure. What does our next inducement do? The exact same thing. Okay, we come up here again, we sweep this level, we have a strong candle down, get a big rejection wick on the mitigation of this area here, then we break lower, so we are also internally already flipped bearish again here. You see how we break structure below this here? And then we have our strong move down, ultimately leading to the next external Breakoff structure, continuing or actually starting here the bearish trend, because this was still our range that we began with. Remember how we began here? And this was basically the initiation of this bearish trend. And coming to our last example, we have another inducement right here. And we can already see that we have another change of character internally here. Okay, so if you can see, this is all bullish, until we sweep this inducement order block. This is also, again, this is a little range before a strong push down that caused huge imbalances this time and an external Breakoff structure here. So this is a perfect order block, but because it is, as we can see with the premium discount again, this is just shallow premium discount, shallow premium. So ends up being swept as an inducement, and then we flip internally bearish again. You see that? We break below this, we break below this, so now we are bearish again. So this could very well be the inducement sweep that fuels the fire for the bearish trend to continue. And this is also why I think we're gonna have this next external Breakoff structure. And I have two predictions prepared here. This is the first one where we mitigate. We have another inducement sweep here internally, tapping into this first supply, and then we sell off. Or prediction number two is we come a little bit higher and have another inducement sweep of this first supply here and really go and get into proper premium pricing here and then sell off. This is my prediction for this pair, and this is what I'm also looking to trade next week. So ideally, I want to see this for good risk to reward. I want to still cover my ass here and take the market down here for, let me see, risk to reward 2.1. Okay, so something like this. Or if I want to be a little bit more aggressive, I'm not sure yet, I could also have it like this maybe for 1.8. So I can get my entry a little bit earlier, and I cover this, and I cover this, and I at least also cover the rest of the imbalance here, maybe like this. So even if it sweeps even this level as an inducement, I still have a chance for it to reverse. But yeah, I'm not sure yet how exactly it's. I'm gonna do it, but I'm gonna look to actually short this because of all the aforementioned reasons. You can't imagine, guys, how much it means to me that you are staying to the end. So I really appreciate it. Thank you so much. I hope I could provide some value with this video. I was really putting a lot of effort into planning this to slowly, incrementally increase the complexity and in the end connect all the puzzle pieces together, right? So please leave me your feedback. I'm a beginner, you know, I need the feedback to grow, so I would appreciate that a lot. And if you have any questions to whatever I just tried to explain to you, please don't hesitate, just shoot it in the comments. I'm happy to help you with that. And yeah, just thanks so much for being here, and I'll see you in the next one. Cheers, guys. Hey guys, just a little update. I actually took this short here by the trendline sweep here I got in, because we had a nice trendline still below. And so I got in, but actually in the most stupid way, I set a limit here, and I didn't set the limit since ages, and I just forgot about it. And as you can see, this trade was like an out of session. This is New York session, okay? This was an out of session, crazy freak move to the upside, and I just forgot that I had a limit here. Just got tagged in and was looking at this nightmare. I already accepted the loss, but it came back, and I gave it some time to play out, but it's just not nice price action, right? For a short at least. We have this huge bullish push out, sweeps the trend line, but then struggles to break lower. Gets stuck here in this new demand, and then comes back up, fails to break the high, thank God for me, sweeps the inducement here for possible longs here. I think it might long here and just leave this trend line here untouched. So yeah, if the shorts play out still, I'm happy for missing it. I'm glad that I'm out for break even. But yeah, if it shorts, then we're probably gonna go at least for this trend line or for the final target. But I wouldn't be surprised if this order block with this fair value gap, this whole demand area here, just does its job and leads to a push out here. So I'm glad that I'm out, because it's super ambiguous right now. And yeah, just wanted to give you an update on that setup, that I actually took it and yeah, ended up being a break even. Take care, guys.